Welcome back to the Allied Wealth on the Money YouTube channel. I'm Ryan Wheless, and I've got an exciting segment for you today. And we're talking about a concept and product that has got so much bad press, yet could accomplish many great things. It's called an annuity, folks, and in some circles in the financial industry, it's a four-letter word. But is it? So I brought my great friend, co-host and radio, TV host, co-host for TV, radio. We do a lot of stuff together.
We do so much stuff you can't even list it.
It's a lot.
Thank you for being here. Let me join you on this. But here's the thing: as soon as you said annuity, there's a lot of folks who are already changing the channel, and I totally understand that. Look, I came from a different financial school of thought, where annuities were not the right kind of thing to implement for folks. It was all about managed money. So I need you today to convince me why you think an annuity is a decent product for somebody to use going into retirement.
Well, for the right situation, it's actually a great product, not just a decent product. And I've got plenty of people out there who love them, but there's plenty of people out there who hate them, right? And it's funny to me, Spike, because people say, well, I hate annuities. Okay, well, yeah. Here they are. Which one of these do you hate? Do you hate all of them? Do you know that there's actually 5 unique types of annuities?
For most people out there looking at the video, they don't know which one, a fixed annuity, a variable annuity, the immediate annuity. Explain them.
We're going to go through all this right now in detail, all right, in great detail. So let's start with this. The first one I like to start with is the immediate annuity. I'm going to make this a little smaller because my print's a little ugly there, all right? So the immediate annuity, Spike, is really simply a pension, okay? And so you give a lump sum of cash to an insurance company. Say it's $100,000. And in exchange for that $100,000 lump sum of cash, the insurance company is contractually obligated to pay you X amount of dollars a month until you die. So let's say it's maybe $600 a month for your $100,000 investment, okay? The thing you have to understand is you're not investing in the annuity, you're actually purchasing an income stream. All right? And the thing about that is, people say, I don't want to buy an annuity because if I die, the insurance company keeps all of my money. And guess what, folks? In an immediate annuity, that is exactly a fact. That's true. That actually happens, okay? So if you buy this immediate annuity and you live for 2 years and step off the curb and get hit by the bus, guess what happens to the money?
It stays with the insurance company.
Gone.
So why don't I just pay myself $600 a month
instead
of giving it to an insurance company?
And Spike, what I say to you is this. What if you live to be 115 years of age? What is your greatest risk in retirement? It's outliving my money due to longevity. We've got medical technology, drugs, procedures, all kinds of things that are keeping us alive much longer. And our greatest risk today is living too long. And the greatest concern of most retirees today is outliving their money. So the cool thing about an immediate annuity is this. If you live to be 105, 107, 110, whatever it is, the insurance company has to pay you as long as you have breath in your body.
All right, so what if my first pushback is, I don't need it immediately. What about 5, 6, 7, 8 years from now? I don't want the immediate because if something does happen to me, if I have a heart attack, die in the ski slopes, I don't want my money going to the insurance company. So immediate off the table for me.
There you go. That's fair enough. And if that bothers you, and you want to leave an inheritance to somebody, oh, no problem. But we know what you could do, though. If you've got $1 million, you could say, look, I want to take $300,000 of my money and I'm going to buy some immediate annuity contracts with that. That will guarantee your income, okay? And the other remaining $700,000 in your $1 million portfolio, you can invest that in the markets and over time can likely recoup the $300,000 you used to buy the annuity with. So there's a lot of strategies out there and ideas and concepts that you can use. But the biggest thing is this. Spike, if you needed your basic living expenses covered, okay, and I mean the things necessary to have any quality of life in retirement whatsoever, food, water, shelter, clothing, access to health care, transportation, fuel for the car, and maybe a little bit of travel, right? How much of those expenses in the form of income would you want guaranteed for life?
Well, when you're talking those, all of it.
Exactly.
As much as I can.
So where could you get guaranteed income?
Well, I could get it from what I know is my savings. I could just take it myself, but then I will agree with the fact that I'm wondering, will I run out of it on my own?
The Bank of Mattress right now, okay, has a negative 8.1% interest.
Yeah.
Right?
Okay.
So if
what you're saying is because of inflation right now being over 8%, I just keep that at the bank, which is literally nothing. I'm losing money.
Under your mattress, not even the bank. I call it the Bank of Mattress, by the way. I'm just going to put it in the mattress, right? And I'm going to take a little bit out here and buy gas for the car, buy bread, milk, groceries, that sort of thing. The reality is you can do that, but what you're doing, if inflation is as high as it is today, is you're losing money while you sleep at night.
Right. Okay. So again, though, the immediate, so what is the normal age frame of somebody who comes in and asks for an immediate?
An immediate?
60, 65?
60, 65, somewhere in there. People can buy these at age 55 and defer the income out, 5, 10 years. There's all kind of structures that you can do, but the biggest thing I want you to understand is that if you buy one, the old adage of if I die, the insurance company keeps my money, it is absolutely true in an immediate annuity.
Okay.
All right. However, if you live to be 115 years of age, they have to pay you as long as you have breath in your body.
All right. What about?
Let's go to the next one.
Yeah, go to the next one.
Okay. So the next one is called a variable annuity. And, when you look at the Dave Ramseys of the world, the Ken Fishers of the world, they say, I think Ken Fisher's got a commercial out that says he'd rather burn in hell than sell someone an annuity, folks. He said that, not me, by the way. That was on national television, surprisingly. And then Dave Ramsey doesn't like these things, okay, or annuities. Well, the thing about it is, what they're really talking about is this product right here. It's called a variable annuity. And on the money, we call it the scariable don't do it.
Yeah.
All right? And here's why, okay? When you buy a variable annuity, what happens is you take $100,000 of money and you put that into this annuity wrapper here, and your money's invested in mutual funds, except they're actually not called mutual funds. They're called sub-accounts. Okay?
Right. This is where it starts to get confusing.
It does.
A
It does.
sub-account of what?
We're going to decode this for you right now, okay? But let's go back for a second. When you put $100,000 into the variable annuity, your money's at market risk in these mutual fund sub-accounts, all right? And when you buy the variable annuity, what you're doing is you're insuring your principal value against market losses, okay?
All right.
So
you're starting to use the gobbledygook speak, though.
Okay, well, let's talk about it.
Principal losses against this and that.
So let's say that you bought this variable annuity January 1st, 2008, okay? And on January 1st, 2009, you walk out to your mailbox, okay? And you open up your statement and you see you've lost 40% of your money. So your account value is now $60,000.
Right.
Okay, we're down to $60,000. And you drop dead of a heart attack right there at your mailbox. Not cool, but you do, okay?
Right.
What do your beneficiaries get?
I don't know. That's why I'm confused.
So you're buying life insurance to offset market losses in your account. So your beneficiaries are guaranteed to get no less than what you put in, and in this case, they would get the $100,000 that you put in the account.
Even though I already took 40% in market losses.
Even though you took 40% market losses. So you're buying life insurance against market losses in a variable annuity contract.
Right, but fees. The biggest thing I hear about variable annuities.
Let's pause.
Okay.
Let's pause. We're going to get to that, okay?
Right.
Here's the thing about it. If you buy a standard life insurance policy and you die, when your beneficiaries get the death benefit, do they pay any taxes on that death benefit?
I believe not.
They do not.
Okay.
Okay. Guess what? The death benefit in a variable annuity is 100% taxable at ordinary income tax rates.
Well, you're not pitching it to me. You're not selling me something.
Like I said, it's a scariable don't do it. Okay.
Okay.
All right. So now, this.
Why would anyone then?
Well, let's go to the fees. Let's go to the fees. Okay. So the fee for this is called an M&E fee.
Right.
An M&E fee does not stand for money and entertainment. It stands for mortality and expense. Okay. And it's an insurance charge. And these charges are typically around 1%, and I've seen them much higher. All right. Now, there's a little bell and whistle that they can throw onto this to where your death benefit on your policy can increase at a rate of maybe 5% per year every year. So that in this scenario, if you bought the death benefit enhancement rider, your $100,000 value would have grown to 105 in the 2008 scenario we talked about.
Okay,
and
but
your
what does this rider?
$105,000.
What does this rider cost me though?
They're
I say giving me 5%. What are they charging me? Another
They are
2%
typically
a year?
0.8% a year. Not a huge amount of money. So about
under 1%.
Yeah, about 0.8% a year. So we're here about 0.80% per year.
All right.
So now we're at 1.8. All right. Okay. Let's go back to these mutual funds, these sub-accounts. All right. So let's say that the issuer of this policy, this annuity, is AXA, because they're big in the annuity space, the variable annuity space. What they do is they call PIMCO and say, hey, PIMCO, we want to put your PIMCO Total Return Bond Fund inside of our variable annuity contract. And we want to be able to offer that as a sub-account to our policyholders. PIMCO says, hey, no problem. we will let you mirror our fund inside of your variable annuity sub-accounts for a
fee.
They're going to charge probably 0.4 basis points, 0.40%, okay? But guess what? AXA is smart, and they're in the business to do what, Spike?
To make money.
No question about it. So what are they going to do? They're going to mark that fund up inside of the variable annuity contract. So the 0.4% expense ratio that you could buy from PIMCO outside of the variable annuity, now inside the variable annuity, costs you 1%. So now these fund expenses average 1%.
But if the function of what I wanted was that PIMCO fund, why wouldn't I just go get that on my own?
You're asking a great question, and we're going to get there.
All right.
Okay. So now let's just add this up. We're already at 2.8% in fees. All right. Well, now what they do is they have an income rider that will guarantee you a distribution rate off of the highest value your contract reached. So here's what I mean. Let's say we started with $100,000, and over time the contract grew to $200,000. But then the contract falls, because in the market there's market risk, back to say $120,000. All right? So your account value is now $120,000, right? Well, what they'll say is that we will guarantee you 5%. And you think to yourself, well, I'm getting a 5% guarantee, when rates were paying 1%, that's great.
Yeah.
Now rates are higher than that today, obviously, but back when they were 1%, that sounded pretty good. Well, this 5% is a distribution rate, okay? And what happens here is you take your highest obtained value, you multiply that value times 5%, and that's $10,000 a year in income they will guarantee you either for life or into your contract value of $120,000, which is zero. And they begin deducting that $10,000 a year payment off of your contract value of $120,000 remaining, plus the fees.
Okay. How often does that happen, though?
How often does this up and down happen? A lot.
Well, the up and down, yeah, but how often do people... Part of my problem is that I hear that most people use annuities in a way that they never get to the using the income part of it.
That's exactly right.
So you've been trying to tell me for a while that they're just as much of an investment as other investments that are out there. They're a contract investment that you use for 5 years for shorter ones like MYGAs, or 10 years. How often do you actually see in your practice people who turn on the income in an annuity?
From a variable annuity, never.
Oh, okay.
I've never seen it happen. I've never seen it happen. People realize, if we do the math on these, by the way, that income feature we were just talking about costs about 0.8% on average, okay? So the total fees that we're up to right now is 3.6%. If you have $1 million, and I've seen this many times, in a variable annuity contract, your fees are $36,000 per year. $36,000.
Right.
Okay? So now we're getting to where I believe your mindset is, which we were talking about at dinner last night, right, in detail, which was the whole impetus of us doing this segment right now, is based on the variable annuity. Because to me, why on earth, as you said, would I pay 1% to get the PIMCO bond fund?
I could get it for
0.4, 0.6%, whatever it is, outside of the variable annuity contract. Why would I want to pay for life insurance inside this policy when my beneficiaries get a death benefit that's
tax-free?
Exactly. Versus I could do it outside the policy for less money, 100% tax-free, right? And the income benefits, to me, I'd rather take less money and put it into an immediate annuity and probably get a higher income benefit guaranteed for life.
Unless I get hit by the bus.
Unless you get hit by the bus.
The insurance company keeps it.
Exactly right.
And again, I said, I've become more of a student of annuities and realizing there are places that it could be used. The immediate, I get what you're saying. The variable still stinks to me.
It is. Dave Ramsey and Ken Fisher, that is the program they're talking about right there.
One of the things I do understand is that people are now confusing different versions. So the immediate annuity is when you do lose it. Does that also happen with the non-variable annuity?
Well, let's go to the fixed annuity.
Okay.
All right. A fixed annuity is exactly that. Back in the 20s, there were people wrapped around the bank buildings, all right, and they were putting this money in the banks in the form of this thing called a certificate of deposit, a CD,
CDs.
Okay? Right across the street was the insurance building, all right? And the guys at the insurance building are going, wait a minute, we make money the exact same way the banks do. So why are the people wrapped around their building but not wrapped around our building? We want people wrapped around our building depositing money with us. So they came up with the concept, a fixed annuity. And it is it's the insurance industry's competition for a bank CD. There really isn't a lot of difference between the two. And here's what I mean. You put $100,000 into a fixed annuity, and you're guaranteed, say, 5% interest for 5 years. What does that sound like?
It sounds like a bank CD. It's just, I think people feel that the bank is safer.
They can. We can get into the legal reserve system, and we will momentarily, that backs up insurance companies, which I personally think is as good as FDIC insurance, by the way, okay? But in this scenario, let's focus on the product for a minute. This $100,000 bank CD or fixed annuity pays 5% for 5 years. What happens in the 5-year period to the money plus the interest if you die during the 5-year period?
In the fixed annuity, I'm hoping that it goes to my family.
It absolutely does.
Okay.
Okay, so we get confused when we hear the immediate
Do they get
annuity.
The growth and everything as well,
Absolutely.
or just what I put in?
Yeah, absolutely. So if they get the growth, the interest, the whole 9 yards, okay? But we get confused about this because, as you said, annuities can be confusing, and they are because there's so many of them, right? So many different types. So in an immediate annuity, if you die, the insurance
goes
company
to the insurance company.
gives some money.
Variable annuity.
There can be some death benefits, obviously, we talked about that.
But then it's taxed.
Then it's
to
taxed,
your family.
okay? Then lastly, in a fixed annuity, whatever the value of the account is, the day your death certificate is stamped, goes to your beneficiaries, no questions asked.
And without taxes.
Without tax
consequences.
there can be tax consequences if it's an IRA, okay? There can be tax consequences if it's outside of an IRA, because one of the cool things about a fixed annuity is they actually go tax deferred. A bank CD's interest is taxed every year.
All right, so that is one of the positives that I always hear, is that they grow tax deferred. Do we ever pay the piper on that growth?
Sure. I mean, there's 2 guarantees in life, Spike. We know what they are, death and taxes. You're going to pay taxes on the growth eventually. But you only pay taxes on the growth when you pull money out. And I have actually had clients
very similar, though, to your 401k.
Annuities over and over and over and over and over the years, and have a lot of tax-deferred money out there. Now, if their beneficiaries inherit that money, at some point in time, they're going to have to pay the taxes.
All right.
If they take the
but
policy,
it's the same as our 401k or 457. You got to pay your tax on it. So annuity, tax deferral. That's at least positive there. But I do want to talk more about that. The comfort that everybody knows is if I've got $100,000 of money at the bank, it's FDIC insured. What is the organization that you're saying that backs what happens with annuities?
I want to get there, okay?
Right.
But let's go back to this for a second, because I want you to understand there's no fees on a fixed a fixed annuity.
Okay, stop. I hear that all the time, and that's where the pitch spooks me. When people say no fees, somebody's getting fees. Like you said, the entire insurance industry, they're there to make money. It's a $1 trillion industry. There's got to be fees somewhere. Are you just saying that I don't pay them out of my own pocket?
What I'm saying to you is this. The insurance industry designed a fixed annuity to compete with bank CDs back in the 20s, okay? What kind of fees are on a bank CD?
Nothing that I'm aware of that comes out of my pocket.
None. Guess what? There are 0 fees on a fixed annuity. None whatsoever. None. It works just like a bank CD does.
What about like internal expense ratio? Those words, those hidden.
None. So the question you need to ask me right now is, how does the insurance company
how does the insurance?
money?
Yeah, why would they do it?
They make money the exact same way banks do. They take money in, all right? They pay you a rate of return. They loan it out in various forms, and they get a higher rate of return they're paying you, and they keep the difference for themselves, and that's called their spread. It's the exact same way.
And it's something we were talking about, is that overnight, my money isn't at the bank.
No.
Right? I know that the banking industry is loaning that money out at a lower interest rate that the Fed gives them, and they trade their money back and forth, whether it's in the United States or even overseas, and then it's kind of like me sneaking out when I was a teenager in high school. My money goes out at nighttime and sneaks in before my parents wake up in the morning. My money at the bank does the same thing. And the reason they're giving me an interest rate is because they get to have my money to play with, to invest, to make more for their own.
Yep.
You're saying the same thing on the annuity.
That's exactly right.
So I'm giving my money to them for a certain period of time. So again, then with this version of annuity, how often do you see people actually turn on the income?
Well, this one doesn't have any income riders. It is the cleanest product out there. There's no ancillary benefits.
So it really is an investment
tax deferral.
Tax deferral.
$100,000 in, 5% guaranteed growth every year. Get all your money back at the end of 5 years. You've gotten all of your interest payments, and guess what else?
And my question is, I'll answer that. Is that they're giving me 5% because I'm guessing they can make more on their own holding onto my money somewhere
Correct.
else. Which is fine, because I don't know that every single year I can guarantee I'm going to make myself 5 or 6 or 7%, especially when I know that the markets, like this year, have gone 20 or 25% down.
That's right. So to that end, the other thing about this is that you have access to your money. You can take out 10% of your account value during the 5-year term of this program. Can't do that in a CD, by the way. Can't take any money out in a CD without paying a penalty. In a fixed annuity, you can. And some of them will allow you to take out your interest per year if you want to as well.
That was the next thing.
Now,
we often hear annuities are illiquid.
That's exactly
that
right.
I can't get to
My money's locked up.
My money is locked up. Now, I really, in a bank CD, again, my money's locked up for a year or 2 years, but Grandma and Grandpa usually don't mind doing that.
It's shorter term. People can get to it if they need to, that sort of thing. And in a fixed annuity, your money is not locked up in any capacity. There is a schedule of surrender charges. Usually in a 5-year fixed annuity would look something like this. A 5% charge the first year, 4% the second year, 3% the third, 2%, 1% the last year, and 0% at the end of the 5th year in this example, okay? So there are liquidation charges. And the reason why there are liquidation charges is the way the insurance company is investing your money. If you liquidate the entire account early, there's going to be a charge to the insurance company. They risk losing their underlying investment, losing money on their underlying investments. That's why they set these up, all right? The other thing too is that if there was a run on the banking system, which there could be, the penalties are 6 months interest in most cases. It's a little steeper on an insurance company, and that's one of the things, by the way, that makes them a little bit stronger, in my humble opinion, in the banking industry. Okay, that's my opinion, by the way. It's not fact or fiction, it's my opinion, all right? And so to that end, if I know that I've got to take this massive hit to my money to get my money out, it's going to deter me from making a run on the banks, okay? Excuse me, on the insurance companies.
Right.
To that end, I always know where I stand in a fixed annuity, right? Which is cool. I typically get a high rate of return in the banks, and I pay no fees. So if you're somebody who understands this stuff, you keep liquid money that you need the next 1 to 3 years liquid. You keep money 3 to 5 years out in something like this. And in longer term dollars, you start looking at other investment opportunities where if the market goes down during your investment term, you should have enough time during that 5-year period of short-term liquid investments, something like this program up to 5 years, to where during that 5-year period, the market may go down, but it should go back up in most cases, right? So it's looking at the way you kind of structure your entire savings through retirement, right, to utilize the proper vehicles in the right places. And this can be a great vehicle for shorter term dollars.
So what you're saying is, let's say somebody's got $1 million in savings, and maybe this is, and I'm just pulling a number out of my head, 200,000, and this is going to be our money that we use 10 years from now, maybe, or maybe even we're going to roll it over into another one if we want to. So is this the money that we're pulling out, let's say, from our 401k when we retire from where we're working from?
Can be.
And to be honest, for disclosure for everybody else out there, I know that you're not just talking about this. You actually started doing annuity when you were in your 30s. You started purchasing annuities when you were in your 30s.
I did.
As opposed to, now, at the same time then, were you also investing in the markets? So you
actually, I bought the annuities first. It was the first thing I did.
So you actually walk the walk, and you still do that. So for your clients, and because we'll talk about this with Allied Wealth, and we'll do it on the TV and the radio show, this is only a portion of what you might do with some of your clients.
Sure. I mean, and you don't ever put all of your money in one. The old adage, folks, you don't put all your money in one basket, all your eggs in one basket. It's the same thing here, right? Here's another great use for this program right now. The 60-40 portfolio, Wall Street Journal came out yesterday and said the 60-40 portfolio is dead. There's no place to hide. The reason why is the 60% of the 60-40 portfolio, excuse me, the 40% of the 60-40 portfolio is bonds. And what's happening to bonds right now?
Bonds are having the worst run in 4 decades.
They're down. Well, the bond market's down almost 16% this year. Okay, I think it's been down a bit more than that, by the way. Well, check this out. If I'm trying to get about a 5% rate of return on my bond portion of my portfolio without interest rate risk, could this work as a replacement for my bond portfolio that's losing money? And the answer is absolutely yes, it is, because you're passing the risk of rising rates to an insurance company, which is pretty cool, by the way, right? So that means my bond portfolio, my overall 60-40 portfolio, if I replace the bond portfolio with something like this, I remove the risk of loss.
I'm going to have to wrap this up because I've got radio and TV to go and run and do, and so do you. But let me ask you this. Do you pitch this stuff to your parents? to your friends, to your family?
Absolutely. We're not done yet. We're going to finish this. Okay. We've got one more.
One last round 10.
Because this is the one that we were talking about last night that you didn't understand. And This is where I want to get to.
Okay.
Okay. This one is called the fixed index annuity. All right.
Okay.
And so we talked about a fixed annuity moments ago paying 5% interest, right? Well, here's what happens in a fixed index annuity. Instead of paying the policyholder the 5% interest, the insurance company allows that interest to be invested into a stock market index in the form of a call option. Okay?
Okay.
So we take this 5% and we buy a option on, say, the S&P 500 index. Okay? What are we putting at risk? Are we putting the $100,000 of principal value at risk? No. We're simply putting the interest at risk, the 5% interest at risk. We buy the call option. If the underlying index goes up in value, the call option becomes more valuable. Then a gain is posted to the policyholder's account. So maybe their account goes from $100,000 up to $110,000. Okay? Once their account goes from $100,000 to $110,000, that $110,000 is now part of their principal. This is a principal protected program. All right? So that means they can't go backwards unless they take money out to go on a vacation, buy a car, take the grandkids somewhere.
But this is not the instrument we want to use for that.
Okay? Can be. If there's enough liquidity, you certainly could be. Okay? However, here's what happens. If next year that interest is paid again, because it's paid every year, that 5% interest goes back into buying a call option. And if the market's up here, all right, let's say it falls, okay, goes down. What was at risk? My principal? My gains?
You were saying the interest, right? The interest was all that was at risk.
That's right. The interest, that 5% interest.
Not my $100,000.
Not your $10,000 in gains. So what happens here is that interest goes into by the call option. The market falls, the underlying index falls, and the call option simply expires worthless. And your account stays at $110,000. Next year, they take the bond interest again, and they buy the call option down here. If the call option goes up in value, guess what happens? Your account goes up in value. That's the mechanism behind a fixed index annuity. And it's really not rocket science. All they did was take a fixed annuity that pays standard interest a year and gave you the opportunity to earn more than 5% interest. And there are fixed index annuity contracts out there right now, Spike, paying somewhere between 6 and 8%. The average in the industry right now today
So that's why I see the
7%.
higher number ones is because they're buying the call options.
That's exactly right.
Take a little bit of risk with what is your interest, with
Exactly
what is your growth.
And they're not doing it on the principal. To make the interest larger than 5%. That's exactly right.
All right.
And guess what? No fees on these products. If you die in the terms are 5 years to as high as 10 years. Okay? If you die in that term, guess what happens to the money?
I'm hoping that goes to my family
The
then?
entire account value passes to your family on death, no questions asked.
Okay. Tax-free or some tax
Depends on the
implications?
tax structure. IRA, not tax-free. Taxable dollars, there's tax deferral growth here, so there will be taxes on the growth, not the money you put in the account. You have access to 10% of your account value in these programs. They are subject to liquidation charges, okay? And the liquidation charges may start at 9%, 8%, 7, 6, 5, 4, 3, 2, and 0, for instance, okay? The cool thing about that is you always know where you stand if you don't like the program. So if you, in year 5, decide you don't like this program, you know it costs you 5% to get out. I actually like that, by the way, because if my money's in the stock market with a broker and I want to get out, where am I? Why am I getting out? Likely because of a loss or lack of performance, right?
Right.
I know exactly where I stand in this program. I have no idea where I stand in that stock market account, okay? So folks, I'm not telling you that this is the end-all be-all product or program for you. What I'm trying to share with you is some information about annuities that I think you should know objectively, all right? And so I believe very strongly that in a rising rate environment, a program like a fixed annuity or a fixed index annuity could be a great answer to the bond portfolio portion of the 60-40 strategy that so many of us have relied on for so many years. So folks, I hope you enjoyed the segment. Give us a like and follow down below. Subscribe to the YouTube channel. We'll be back with more content.